Well, thank you, Todd. I appreciate it, and it's nice to be back with your platform and your audience. Today, I want to talk about wealth creation and wealth preservation. We are talking about a U.S. fund today, and so we do have to start with a confidentiality notice and let you know that this message is not an offer to sell or a solicitation of an offer to buy or sell any security or interest in any fund. That can only be made through a private placement memorandum that contains all of the important information about the risks and fees and expenses and is available to accredited investors only. My name's Alex Wilson. I'm the CEO of Precious Timber. I've teamed up with Alan Romero, the CEO of Terrafort, to release a triple blended agri-fund that we'll talk about during the next 15-20 minutes. But mainly the message today is about protecting wealth. We're living in a time that's very unpredictable. Obviously, we know that the developed world is in some serious financial, has some serious financial challenges ahead. And I think it's fair to say that a lot of savvy investors today are moving towards loss avoidance and risk mitigation. They know that there's a big correction coming. So protecting wealth and protecting our future financial situation is very important. But at the same time, we have to generate long-term inflation protected income. How do we do that? Basically, we're talking about keeping the wealth that we have in the family and growing the family wealth, making sure that the wealth can be passed on for those of us that do have families. In Bill Bonner's book, Family Fortunes, it talks about how to build the family wealth and hold on to it for 100 years, when most average families today have very little, if any, at the end of the first generation, and of course the second generation has to start from scratch, and lo and behold, that process continues on. So for families that do have money, and for those of us that do have retirement accounts and IRAs, how do we protect it? How do we grow it safely today? And I'm not just talking about during the good times. Obviously, things have been very cyclical the last 30 years or so, more so than any time probably in our investment history. But how do we make sure that we grow money, not just in good times, but how do we make money in bad times too? Many portfolios got devastated in the last two cycles, 2008 and 1999-2000. But not every portfolio got devastated. Some portfolios did exceptionally well, and that's what we're going to talk about today. How did those portfolios remain stable and have even gains during the crashes when most other portfolios didn't? The average investor, I think it's fair to say, they follow a model that the financial world has basically shared, a 60-40 kind of approach, 60% stocks, whether they be U.S. stocks and international stocks, 40% other assets, keeping your portfolio diversified. That used to work great. I know it's not so sure. I'm not a financial advisor. I'm not a financial planner. But I do know from the clients that we work with, they certainly invest very differently than the 60-40 plan. The two things that the 60-40 plan has in common, it seems like, is a lot of volatility. Let's face it, the cycles that we've been experiencing have been pretty devastating. And so when you have 60% of your portfolio in things that can gyrate and zig and zag, the panic button is easy to press. Our emotions get in the way. We sometimes buy at the wrong time. We sometimes sell at the wrong time. So volatility is a very common point, and also low returns. And some people may argue with that. They may say, "What are you talking about, Alex? The returns have been nice since 2008." Well, let's take a look at what the returns have been like actually, and let's start with the stock market. If we go back to December 31st, 1999, which is what now, 17 years ago. Let's take a look at where your portfolio was 17 years ago and where it is today according to the stock market. Well, on December 31st, 1999, the Dow Jones Industrial Average was right at the peak of its growth at that point, 11,497. Well, here we are 17 years later, and the stock market has rebounded. after the 2008 crash too, and we're at about 20,970 today. So we take 17-year period. How did you do over 17 years if you've been in the stock market? It's up about 80% over the past 17 years. So on an average basis, that's about a 4.7, almost a 5% annualized return. I don't know about you, there's nothing wrong with 4.7%, but I'd like to earn more. How about the NASDAQ in the same period from December 31st, 1999 through till today? Well, the NASDAQ was at just over 4,000, and today it's maybe just a little over 6,000. So about a 45% increase in 17 years. So 2.6% a year on average for the NASDAQ. How about the S&P? The S&P 500 was at 1469 back then. Today it's at 2387. So about a 60% return, about a 3.5% annualized return in the stock market. And of course, we've had another crash since then, 2008. So it went down, it came back up, it went down again, and it came back up. It's been quite a ride. In fact, there are the highs and the falls. December 31, 1999, 11,497. Went all the way down to 7,528. Then it came back up. The height was 2007, October the 10th. It had doubled from 7,500, almost doubled to 14,164. And then, of course, it crashed. Soon afterwards, down to 6,626. And then March the 1st, which was when I put this presentation together, it had catapulted all the way up to 21,000. Of course, it's down now from the high of March 1st, 2017. So that's the roller coaster ride that the 60% of most investors' portfolio has been having. The question mark says, how will it be the next 17 years? Let's take a look at another asset class, shall we, that I know a lot of IRA investors, especially self-directed IRA investors, like to hold. They like to hold real estate. They like particularly income-generating real estate. I do too. But how have we fared in the last 17 years with real estate? Let's take a look. The median house price in the U.S. in 1999 was $172,000. Today, 2017, that median house price is $312,000 across the U.S. So how did we do? Well, if we kept our money in real estate for the last 17 years, we've seen an 80% jump in our in the median home price, so about a 4.7% annualized increase in value. So it's really, you know, I mean, I'm not saying it's good or bad. I'm not here to judge. I'm just here to show you the numbers. How do the wealthy invest? They invest very differently than the average investor, for sure. Of course they do. They have billions of dollars to do it with. And so consequently, they choose and allocate different assets into their portfolio for one main reason. And that reason is loss avoidance. If you have $100 billion, I should say $100 million, or maybe $1 or $2 billion, wouldn't your focus too be on loss avoidance? Never mind trying to speculate and get some high returns. Let's put it into something that's very safe, that never crashes, and then grows money over long periods of time. We're calling it legacy investing today. People like Jeff Bezos and Jack Ma, and previously on the earlier page, Ted Turner and John Malone from Comcast, multi-billionaires that have made money in various industries and invested a large percentage of their portfolio in one particular asset. They've particularly modeled their portfolios, many of them, much like the stories in The Alternative Answer by Bob Rice. Great book for you to read. Grab it on Amazon. In fact, it was the subtitle that kind of caught my attention, The Non-Traditional Investments That Drive the World's Best Performing Portfolios. Wouldn't you like in your portfolio the non-traditional investments that have driven the best performing portfolios on the planet? Absolutely. Why settle for mediocre assets and allocations when you can have those that have driven the best portfolios? Well, what are they? Well, they're not paper assets. In fact, in the first few chapters of the book, it talks about Yale University, and in the 2008 crash, they did very well. The reason they did very well is they had just a small 5, 6, 7, 8% allocation to the stock market. they had a much larger allocation to farmland. Farmland is one of the billionaires, one of the high net worth investors' favorite places to hold and store and create wealth. Dirt is one of those things that, especially arable farmland, there's less and less of it as the population explodes. The particular real estate that they like most is not houses, not rental property. In fact, it's timberland. Timberland is the favorite asset class of the super wealthy. There's a reason for it. We'll get into that shortly. But of course, they're owning the dirt, but they're also owning one of nature's most replenishable commodities with very high values. Some of the timberland across the world has very high values to it. In fact, the graph here shows the cumulative nominal returns measured by the NCREIF Timberland Index versus other assets from 1987 through until 2012. The green line, the top line, is the NCREIF Timberland Index. NCREIF standing for the National Council of Real Estate Investment Fiduciary, the NCREIF Timberland Index. And as you can see, the Timberland Index has been by far and away the best performing asset class when you compare it to global stocks, emerging market stocks, global bonds, real estate, large cap American stocks, and small cap American stocks. But I want you to take a look at something. Look what happened to the green line in 1999 when everything else crashed. See below the green line in 1999 when everything else was crashing. If you held timber, you didn't feel the crash because you didn't experience a crash in timber. How about 2008? What happened in 2008? Well, take a look at the gold line, the emerging market stocks, and take a look at timber. Timber rose after the 2008 or during the 2008 crash. But look what happened to stocks and bonds and real estate. So timber is not only an asset class, if you take a look, it's a line that gradually moves up and rarely goes down. And when it does go down, it's a minute blip. So that's the way the wealthy like to grow their money. They like to grow the money in something that's safe, that's always expanding its production, and of course, it doesn't have any crashes. It's also a very safe place too. Take a look here, 1987 to 2008. This is a composite chart showing large cap stocks, small cap stocks, international equities, corporate bonds, and we take a look at the standard deviation. A number, well, first of all, let's take a look at the left-hand column, the actual returns, the rate of returns. We see the average from large cap stocks all the way down to corporate bonds was 7.1. Timber was double that, 14.4. And the standard deviation, that's a number that you want lowest possible. We'll take a look. The average was 15.3% and timber was nice and low at 10.7. The Sharpe ratio, this is something that you want a little higher. Now, the higher the Sharpe ratio, the less risk, more stability. Timber's at 108 and the average was 0.90. So all the right numbers. Timber has all the right numbers. That's why they use it, 14% on average return from 87 to 2008. Most investors in the timber space love it because of its win-win strategy. The first thing is, of course, the low risk, safety first for their portfolio, keeping the portfolio safe. The second thing, of course, is high return. Now, that's normally not said in the same sentence, low risk and high return. Normally, to get high return, we've been told that we have to take on high risk. Actually, with timber, you don't. You take on low risk and you receive high returns. We're talking about saving, we're talking about protecting, we're talking about growing, we're talking about making sure that our portfolios are not going to be devastated by the upcoming shocks that we've seen over the last 2 or 3 decades. And portfolios really have 4 main jobs. And the first job is risk reduction. So in other words, we should be in asset classes that can stabilize the portfolio when things go down. So risk reduction should be number 1 according to the billionaires and according to the alternative answer. Inflation protected current income should be the second primary focus. In other words, once you've got your portfolio based around as little risk as possible, as little loss as possible, make sure that it continually spins off income. The next two items are long-term growth enhancement. Make sure that you've got asset classes that grow and enhance the value of the portfolio long-term, not short-term speculation, not trying to figure out which is the best IPO or the best sort of risky gamble, but long-term, make money over long periods of time. And then, of course, protecting that purchasing power. The value of the dollar gets weaker and weaker. Make sure that you have asset classes and asset allocation models that protect the purchasing power. So what is our plan? What's your plan? A lot of people say, well, I really don't have a plan. I just follow what my financial planner tells me. Well, I can tell you, unless you're using a fee-only, a financial planner, they have other reasons to place you into certain asset classes. Of course, some of those reasons are commission-based. So what is your plan? If you have no plan, then it's just a wish. A goal without a plan is simply that. It's simply a wish, and wishing to make money and hoping that you're going to have a successful portfolio. I don't know. It's harder and harder to make a portfolio safe, and it's harder and harder to grow a portfolio, it seems, today. So ask yourself, what type of investor are you? Are you a short-term investor? Are you a short-term profit seeker? Do you buy and sell? Or are you a long-term wealth builder? You'll do much better being a long-term wealth builder. In fact, Jim Rogers, one of the most successful investors on the planet, says agriculture is going to be the big thing in the next 20 years. In fact, farmers, he said, will be driving Lamborghinis, and stockbrokers may be driving taxis. You see, the stock market and real estate bubble is here again. I mean, here we are, 2017. We have real estate prices as high as we've seen them in a long time, since 2007. We have the stock market, of course. And with people that I speak to, the stock market could crash anywhere from 50 to 80% from where it currently is. And real estate could really crash this time as much as 50%. In fact, I've seen recently many real estate investors that have particularly good incomes coming from their property. They're now trying to sell off their real estate, sell off their income producing real estate to other investors in a way in which says, hey, this is a good time to buy income property. I don't know about you, but I don't buy at the top of the market. I wait. And so trying to purchase income property today when you know it has a very good chance of having a correction, that should be a question mark. These families on the screen are very wealthy families. On the left, it's the Cargill family. Cargill, of course, the largest privately owned company on earth. And on the right, it's Ted Turner's family. What are they investing in? Well, they're investing in more farmland, more timberland, more agricultural land. The billionaire Jeremy Grantham says timber is the only low-risk, high-return asset he's ever found. He also calls it the best long-term investment he's ever made. We're not talking just any timber here. We're talking about tropical timber. There's nothing wrong with North American timber, the pine, the Douglas, the fir, the stuff that ends up in 2x4s and pulp and paper and plywood and building materials. But we're talking about Central American tropics, where the most valuable, rare, and very, very expensive species are grown in much shorter cycles because of the geographical locations. Some amazing valuable trees are grown in Central America. We're also talking about a perpetual income producer, the coconut. The coconut has become a global commodity. You've seen it. I've seen it. It started off maybe 15 years ago with people experimenting with waters and beverages, and today the coconut is in hundreds and hundreds and hundreds of uncorrelated products across many different sectors. I call it the perpetual income producer. It's actually more like an agricultural annuity. I know a lot of people start to think about when they get close to retirement, an annuity. For me, an insurance annuity that spits out 4, 5, or 6% and only spits it out until I pass, that's not attractive to me. I'm more interested in a tree that's going to produce something every single year for the next 60 years, with me owning the dirt, because whilst the trees are producing income, the dirt's appreciating too. And then, of course, when I pass on, I can pass that land, that producing land, on to my family so that it stays in the family, so that that family wealth is protected. So to me, a coconut tree, a coconut plantation, is an agricultural annuity. Much like the coffee tree today. You know, coffee trees produce every single year. So once again, I look at it as a perpetual income producer. And of course, here we are in the US of A, where more coffee is drunk on an annualized basis than any other country on earth. And of course, we can't even grow a single coffee bean in America. 146 billion cups a year are drunk just in the US. So you can imagine how many coffee trees it takes to produce America's appetite for coffee. For wealth preservation, though, stay clear of the very high-risk perishables. I've seen them all come in all shapes and sizes, from avocados to mangoes, from limes to plantains, to all kinds of different high-risk and very, very perishable items. Wealth preservers look for something, remember, low risk, high return. We're talking about reducing the portfolio's risk, protecting the portfolio's purchasing power, making sure that there's continual inflation-protected income and the long-term growth of the portfolio. It's very important. There are two ways to own real estate in the farming world. You can own it fee simple, or you can choose to join a U.S. domiciled investment fund like ours. Either way is good. In the fund, that's a joint venture between Terrafort and Precious Timber. It's a land syndication. The fund will be purchasing and owning the real estate. And then it will be fully managed by experienced and expert agricultural personnel. And there'll be three species, there'll be three different asset classes. There'll be very tropical, valuable timber, there'll be coffee, and there'll be coconuts. And we will be growing and harvesting and selling those commodities on an annualized basis. It's available to accredited investors that seek long-term income, long-term capital appreciation, and long-term wealth preservation. The fund will acquire 1,772 acres of productive farmland right on the Costa Rican-Nicaraguan border, in some of the most fertile agricultural land in Central and South America. 1,000 acres of tropical hardwoods, 172 acres of coffee, and 600 acres of coconuts. And what's nice about the fund, it's been created and structured so that dividends start in the second year. So coffee beans will be sold in the second year, and income will move into coconuts in year 4. So in other words, the income will produce in year 2. It will continue until year 4 when it's increased, and then in year 12 when the harvesting of the trees begin. And so over the life of this 20-year fund, it's projected to realize an 8x return on investment. The fund will start producing, as I said, a little bit of cash flow in the year 2. It'll grow in year 4. It'll grow in year 5. In fact, the longer you stay in, the more you'll make. Year 6, it'll be very, very attractive. And then from 6 on, it's going to really supercharge someone's wealth. Obviously, we're talking about capital appreciation. We're talking about capital preservation. And we're talking about superior long-term risk-adjusted dividends on an annualized basis. Also, because of the structure that the fund has embraced, it's also will be recognized as an impact investment, meaning there'll be a lot of social and environmental initiatives and supporting mechanisms for the local community, for the local environment. It's a growing segment of the investment world. Over $1 trillion is estimated to be invested in impact investing by the year 2020, spinning off $660 billion in estimated profits to be made across the impact investment platform. We've seen a lot recently about investing in cannabis, and I know a lot of people have invested in cannabis, and I think that's great. For some people, morally, or they're on the other side of the equation. I'm not here to judge. I'm not here to say yes or no, but I can tell you one thing. If you've invested in cannabis, then why in the world would you not invest in 3 commodities that the global population is going to demand in greater numbers over the next 17 years. If we have a 17-year period during the next 17 years like we've had the last 17 years, I don't know about you, but 4.5% from the stock market and 4.5% from real estate, that's not what I'm looking for. In 1999, when we were talking about the numbers of the stock market, there were 6 billion people on the planet. Well, in 2017, there's 7.5 billion people on the planet. And 17 years from now, in 2035, there'll be almost 9 billion people on this earth, which means we're going to use more wood then than we're using now. Right now, every single American uses one 100-foot log every year. So there'll be more lumber produced and more lumber needed and more lumber consumed. Likewise, there'll be more coconut products than there are today. And of course, there's more people, so more cups of coffee. So where else would you place your money for the future than in agriculture to give you a pretty much, you know, I'm not going to use the word guaranteed, but as the population increases, I think we're pretty much assured that the demand and the need for the products that we'll be growing will increase. So it's time to think outside of the box. It's time to say, let's be done with the 40-60 plan, the one that hasn't performed that well for the last 30 years or so, and actually do something with my portfolio. Make sure that my portfolio drives my profits from a biological standpoint. You see, we're talking about something where our profits are generated by Mother Nature, not by Wall Street. And so when your money is growing biologically, it doesn't matter what happens to Wall Street or the economy, because your trees will continue to biologically grow. They'll produce coffee beans, they'll produce coconuts, and they'll produce lumber regardless of the ups and downs of the economy. That's called a loss avoidance strategy, making sure that your portfolio is in a position to make a profit even when things are zigging and zagging, and assure yourself of inflation-protected income. The fund is available to accredited investors only, and the units are $50,000 per unit, and it's an ideal place for self-directed IRA holders or 401k holders. Now, we have a very, very short window for the early-in promotion. $50,000 units, any investor that would reserve 3 units or more will receive a free VIP tour, all expenses included, plane ticket, accommodations, ground transportation, and refreshments and food. A free VIP tour to visit our timber, coconut, and coffee plantations. So if you're thinking about the fund and thinking about accessing agriculture, remember, this is a US-based fund. It's strictly built for those 3 main points of the portfolio of making sure safety and long-term growth and income are combined. We have a lot of fun on the tour. It's a great adventure. We generally limit the tour to about 12 to 15 people so we can get to know each other, and so that you can get to know the staff, all the people that will be taking care of managing the property and the commodities for us. Yes, we have some fun. We drink some fresh coconut water. We spend a little time wandering around the town. People come from all over the world, all over the country. It doesn't matter whether you're 35 or 85. People love coming to Central America. They love the friendliness. They love how the Central Americans love Americans and Europeans. They have a very warm heart. And of course, it's a very, very peaceful part of the world right there on in the border of Costa Rica and Nicaragua, 2 great countries. So join us on one of these discovery tours. Come and have some fun. Come and learn about this alternative space. Our next discovery tours are June 3rd and 4th and June 10th and 11th. And as I said, we're trying to limit those to 12 adults only. And right now, we're getting quite a few reservations for the June 3rd, 4th trip. If you have any questions and need some answers, please don't hesitate. This is a very, very effective and a very, very focused triple blended agricultural fund that I think is going to remarkably transform someone's portfolio over the next 17 to 20 years and really protect it from these up and down expected sort of zigzaggy emotional backed situations that we probably are going to face. For more information, you can call us direct at 855-888-6288. Once again, 855-888-6288. Or go log on to PreciousTimber.com or www.terrafort.org. So once again, PreciousTimber.com or Terrafort.org. I thank you very much, Todd, for the opportunity, and hopefully I'll be able to address and answer any question. Have a great, great investment future.